Hello and welcome. Today, we're going to tackle a really crucial question for a lot of businesses out there. How do you move your factory to a modern special economic zone without getting hit by a massive capital gains tax bill? Well, the answer is tucked away in a very powerful provision of the new Income Tax Act, 2025, Section 88. So let's dive in and see exactly how it works. I want you to picture this. Your client has a factory, and it's sitting on some prime urban real estate. Its value has just shot through the roof over the years. Now they've got their eye on the future, a state-of-the-art SEZ, which is absolutely essential for them to scale up. The problem? Selling their current property is going to trigger a huge capital gains tax. So, as their trusted advisor, what's your move? How do you solve this?
Well, the good news is the law gives you a specific tool for this exact situation. It's Section 88 of the new Income Tax Act 2025. You can think of it as a key designed to unlock this kind of strategic move for businesses, freeing them up from what could be a really crippling tax bill.
So here's what we've got on tap for this explainer. We're going to start by decoding Section 88 itself. Then we'll walk through the conditions you have to meet for the tax exemption and run through a practical case study. After that, we'll cover the really important stuff, compliance and common pitfalls, before wrapping up with the key takeaways you need to remember. Okay, let's get right into the nitty-gritty. What exactly is Section 88, and more importantly, what is it trying to accomplish? At its heart, Section 88 is way more than just a tax law. It's a piece of economic strategy. The government's goal here is pretty clear. They want to decongest our crowded cities and encourage planned industrial growth. And how do they do that? By offering a big incentive, a tax exemption for businesses to move to these special economic zones. It's a win-win, really. It boosts exports, eases urban pressure, and makes a big strategic move financially possible for businesses. Now, for all you seasoned professionals watching, this whole idea probably sounds pretty familiar, right? That's because Section 88 is basically the new avatar of Section 54GA from the old 1961 Act. The policy, the core idea, it's all the same. The new 2025 Act just aims to simplify things, so it's been renumbered and restructured, but the benefit continues.
Okay, so the big question is, who can actually claim this? Well, the law is super specific here. The exemption is for an industrial undertaking. And what does that mean? It means a business that is actually manufacturing or producing things. This isn't for service providers, it's not for traders, it's aimed squarely at the manufacturing sector.
So the first piece of the puzzle is where you're starting from. The move has to begin in what the Act calls an urban area. Now, this isn't just some vague term. It's a specific classification based on things like municipal limits and population density. The very first step is making sure your client's current location actually qualifies. And where does the business have to move to? It has to be a special economic zone, or SEZ. These are specific, demarcated areas set up under the SEZ Act of 2005. For trade and tariff purposes, they're pretty much treated like foreign territory, and they come with a whole host of benefits to boost exports. To get the Section 88 exemption, this is your mandatory destination. Okay, we've got the what and the why down. Now for the really important part, the how. What are the absolute essential conditions you have to take off to get this tax exemption? Section 88 gives us a really clear four-step checklist. First, your capital gain has to come from selling specific assets. We're talking land, buildings, plant, or machinery from that urban location. Second, the entire industrial undertaking has to move to a notified SEZ. Third, and this is the big one, you have to reinvest the funds into new assets for the business in that new SEZ. And finally, you have to do all of this within a very specific time frame. Now, this is where it gets really interesting. Check out this timeline. The law actually gives you a pretty generous window to work with. You can buy the new assets up to 1 full year before you even sell your old property. Or you can wait and buy or construct them up to 3 years after the sale. That kind of flexibility is just incredibly helpful when you're planning a massive business move like this. All right, theory's great, but let's see how this works in the real world. Let's put some numbers to it and see how it all shakes out. Okay, let's imagine this. You sell your old factory for 5 crores. After indexation, your cost was 1 crore, which leaves you with a capital gain of 4 crores. Now, have a look at scenario 1. You go and reinvest 4.5 crores in new assets in the SEZ. Since that's more than your 4 crore capital gain, your taxable capital gain is 0, nil. The whole thing is exempt. But what about scenario 2? Here, you only reinvest 3 crores.
In this case, your exemption is only up to the amount you reinvested. So you take your total gain of 4 crores, subtract the 3 crores you put back in, and that leaves 1 crore that is still taxable. So you see the logic, right? It's actually pretty simple. The rule is that your exemption follows your reinvestment. If you reinvest more than the capital gain, you pay no tax on the gain. If you reinvest less, you only get an exemption for that lesser amount, and you pay tax on the rest. It's a really clear, straightforward mechanism. As our little case study just showed, claiming this exemption can be a massive win. But keeping it? Well, that requires some serious attention to detail and compliance. So let's talk about the practical side of things and the common mistakes you need to avoid. Okay, for compliance, first things first, your paperwork has to be perfect. I'm talking detailed records of both the sale of the old assets and the purchase of the new ones. You absolutely must have proof that the business was actually shifted. And crucially, you have to claim this exemption in your income tax return and file it on time. Oh, and be ready to provide any special forms, which might even need a certificate from a chartered accountant. Now, this is the part you really need to listen to. These are the traps. The most dangerous one is something called the clawback provision. There's a 3-year lock-in period on the new assets you buy. If you sell them within those 3 years, that exemption you claimed, it gets taken back. It becomes taxable in the year you sell the new asset. Ouch. Other big mistakes are using the money for the wrong things, missing that 1 year before, 3 years after timeline, or not shifting the entire business. Any one of these can blow up your whole claim. All right, we have covered a lot of ground, so let's just boil it all down to the absolute must-know points about Section 88. What do you really need to walk away with? Here are your key takeaways. Number 1, purpose. It's all about encouraging moves from urban areas to SEZs. Number 2, eligibility. It's for industrial undertakings moving their main assets. Number 3, condition. Reinvestment within that specific timeline is everything. Number 4, exemption amount. It's capped by how much you reinvest. And finally, number 5, and I can't stress this enough, caution. Watch out for that 3-year lock-in period on your new assets. So as we wrap up, here's a bigger picture question to think about. Section 88 isn't just the tax rule. It's a tool for economic policy. With SEZs being so central to India's growth strategy, you have to wonder, how will financial incentives like this continue to shape where our industries are built? And what will that ultimately mean for the future of our cities? And that's a wrap on our deep dive into Section 88. I really hope you found this breakdown helpful. If you did, a quick like and subscribe would be fantastic. And of course, please share this with any colleagues who might find it useful. Thank you so much for your time. And just a quick final note. Please remember, this video is for educational purposes only. Tax laws are complicated and they can change, so for advice on your specific situation, please always consult with a qualified professional.